I mean, the credit bubble is that this is the largest credit bubble in history, and the easiest way to understand that. I mean, most people don't understand that we are in a credit bubble, but if you tell them that we're in a debt bubble, now that makes sense.
Right.
But credit is the other side of debt. Credit equals debt, always, always. It's two sides of a balance sheet. So if you've got maximum debt, then obviously you've got maximum credit around. And what the Austrian economists call the business cycle, in fact, is actually driven by bank credit. And it's when banks not so much destroy credit, because it's the only way credit can be destroyed is basically through defaults, if you like. What they will tend to do is they'll tend to move their lending away from the private sector to safety. And the regulators say that the safest place to lend, of course, is short-term to your government, which is why the government is selling so many T-bills, is particularly growing evidence that the global economy is slowing. The US economy is slowing. I mean, I think it was Atlanta Fed produced some quite alarming figures the other day, last week, suggesting that, in the last quarter or the fourth quarter, whatever, things have actually slowed very, very sharply. And we're now in a recession. And if we have another quarter like that, it's going to be a technical recession or an official recession. But I mean, they're only saying half the story, Danny, because if you take the budget deficit, which is roughly 6.5% of GDP, out of GDP, you're then left with the private sector. And on the Congressional Budget Office's own figures, total GDP, they expect in this current year to be growing at 4.5%. So on their figures, the private sector is already contracting by 2%, and that's in nominal terms. And then if you put in inflation adjusted or just CPI adjusted, let's not use any sort of fancy numbers, just the official numbers, then quite clearly it's contracting at the rate of about 5%. Now that, by any definition, is sort of verging on a slump. That is the background to it, and I think investors are beginning to get sort of concerned that this indeed is the case. I mean, they've ignored it so far. They've ignored it because of greed. I mean, you got all this credit,
right?
$1 trillion of leverage in the U.S. stock market, and the bulk of that, I guess, we don't know for certain, but the bulk of that, I guess, was sort of chasing fancy tech stock. So, this bubble, when it bursts, I think could be rather nasty. And the other point I would make about it is that not only do we have a mega credit bubble bursting, we also have Smoot-Hawley Mark II tariffs being brought in by Trump. And already you see, the new prime minister in Canada saying, we're going to hit back with our own tariffs and all the rest of it. We've got exactly the same combination, but this time it's actually a lot more violent. This is not good. So I am extremely pessimistic on the outlook for stocks. I think that they will fall so much that stocks value as collateral will start, if you like, upsetting the banking system. We already have a commercial real estate disaster in America. I also think that, obviously the Fed is going to do what it can to try and rescue this situation, but the extent to which it does it is going to undermine the dollar. So what are the foreigners going to do? The foreigners are going to say, we don't want our dollars anymore. It's quite simple. Now, their own currencies, I have to say, are in a similarly powerless condition. So what do? The only thing they do is just get out of credit and get into real money, which is gold. And so a brief summary of the current situation as I see it.
Now let's bring it all together. We left off discussing the twin pillars of systemic fragility, credit saturation, and fiat devaluation, and why gold and silver are uniquely positioned as monetary fire exits in the coming storm. But allow me to go further, because what's playing out isn't just a monetary story, it's the endgame of a century-long financial experiment, and the experiment is failing. Let me be absolutely clear. We are at the tail end of a super cycle in credit, a cycle that began in earnest with the post-World War II Bretton Woods framework, was unanchored completely in 1971 when Nixon closed the gold window, and has since ballooned into a grotesque debt-based system reliant on perpetual expansion. It's built entirely on confidence, and confidence is one of those things that works until it doesn't. The only thing more dangerous than a system built on leverage is one that requires ever larger doses of it to remain stable. Now, the central bankers know this. Of course they do. Why else would they be stockpiling gold at the fastest rate in over 50 years? Why else would 2022, 2023, and now 2024 each set new records for central bank gold purchases? It's not about diversification anymore. It's about monetary insurance. What you're witnessing is a shift from dollar hegemony to a multipolar world, and gold is the neutral settlement asset in that transition. Think of it as the global ledger being rewritten, and gold is the ink. Now let's talk numbers. The gold price is approaching $3,000, and I can tell you with a straight face that it's still undervalued. Why? Because the price of gold doesn't just reflect inflation, it reflects the degree of mistrust in the currency system. And when you've got $34+ trillion in US federal debt, over $100 trillion in unfunded liabilities, and deficits running north of $2 trillion a year, it's not a question of whether the dollar will be devalued. It's a question of how and when. Let's consider what that looks like. If the US Treasury were to revalue gold, not in the market, but officially, from the current book value of $42.22 to just $4,000, that would inject $1 trillion directly into the Treasury General account. At $10,000 gold, that's $2.5 trillion. And as I've noted many times, this would require no act of Congress, just a directive from the Treasury Secretary to the Federal Reserve. Now let me ask, do you really think they won't go down that road when the next crisis hits? When the dollar's purchasing power is visibly disintegrating, and the only asset left with any credibility is sitting dormant on their own books. History tells us that they will. Roosevelt did it in 1933, Nixon did it in 1971, in reverse. And it will happen again, not because it's politically expedient, but because there will be no other option. Let me be candid. The bond market is broken. The credibility of the fiscal authority is shot. And the public, yes, even the average American or Briton who still believes the system works, is beginning to question things. You see it in food prices, in housing, in wage stagnation, in the grotesque gap between Wall Street and Main Street. This is where gold and silver re-enter, not as speculative assets, but as anchors of confidence. Now, what about silver? Ah, yes, silver, the poor man's gold, as it's called. But don't be fooled by the nickname. Silver is not some industrial afterthought. It's a monetary metal with 5,000 years of history behind it. And right now, it's screaming undervaluation. The gold-silver ratio, hovering near 85-1, is an aberration. Historically, that ratio has oscillated between 15-1 and 30-1. Even during modern monetary crises, such as in 1980 and 2011, it collapsed below 20-1. So let's play with that math for a moment. At a 20-1 ratio and $3,000 gold, silver would be at $150 an ounce. That's a 5-fold increase from current levels. And that's just to get back to historical norms. Now factor in 7 consecutive years of global silver supply deficits. According to the Silver Institute, industrial demand, especially from green tech, solar, and EVs, continues to outpace supply. And investment demand, still in its infancy, especially in the West. Western investors are not only underweight silver, they're almost absent. ETFs have seen outflows. Bullion dealers report light volume. The public, addicted to tech stocks and meme coins, simply hasn't caught on yet. But they will. And when they do, they'll find a market with paper promises outnumbering physical ounces by 100-1. They'll find refiners quoting 10 to 12-week delivery windows. They'll find bullion banks desperate to close out short positions they can no longer roll. They'll find panic. That's why I say again and again, you must own physical. Not paper claims, not unallocated credits. Physical gold and silver outside the banking system. And let me address another point, because I hear this one a lot. Won't they just ban gold? It's a valid concern. History offers precedent. But the political landscape is very different today. In the 1930s, gold confiscation was possible because it was still money. Today, it's dismissed by the media as an archaic relic. Most citizens don't own any, and those who do are scattered and relatively anonymous. Moreover, the government doesn't need your gold. They'll simply devalue the currency. That's the modern confiscation. They'll print, They'll inflate. They'll promise more social spending, more bailouts, more stimulus, and they'll pay for it by devaluing your savings.
The first thing I would say is it's not gold and silver going up so much. I mean, there is an element of that. You can't disentangle it, but it's basically paper currencies going down. This is actually what the central banks see. The reason that central banks are buying gold is that they're actually selling fiat. And, that is a very important point to understand. Ultimately, when everybody understands that it's fiat going down and not prices rising, and we're not just talking gold at this stage, but we're also talking about, groceries and everything else, then the currency's doomed. So we are on the beginning of that curve. In fact, we were on the beginning of that from 1971, when we started in 71 with $35 an ounce, and we're now close to 3,000. But obviously, the way people think, they're not thinking like so. They're trading it as if it was a stock or whatever, I would personally think that 3,000, there could be some consolidation around about that 3,000 level. It's a view. I wouldn't sell on the basis that it's going to, it's going to consolidate and it might tip back and you might be able to do this, that, and the other. Why? Because if I sell gold, I'm buying dollars. I don't want to buy dollars. For goodness sake, I want to get the hell out of them. And as far as silver is concerned, I think with the gold-silver ratio close to 90, that to my mind is far, far too high. Silver does have a monetary role. There is absolutely nothing in the price for a monetary role at the moment. But I think when you get the collapse of currencies, silver has got two advantages. Firstly, it's, somebody said it's the poor man's gold. I think that's actually, a sort of a reasonable description for the role of silver in terms of being useful for smaller transactions. If you think that the politicians might try and ban ownership of gold, and politicians are stupid, let's face it, when it comes to economics, they are on a completely different agenda. But then you ask the question, okay, if they ban ownership of gold.
Let's continue down the rabbit hole, shall we? You see, this isn't just a technical correction or a cyclical slowdown. What we're witnessing is the potential endgame of the largest global credit cycle in recorded history. And it's not happening in isolation. This is global, systemic, and terminal. The central bankers can't paper over this one with another decade of cheap money, and they certainly can't hike rates enough to get ahead of the inflation they've unleashed without blowing up the sovereign debt markets or bankrupting their own governments. The only real option left? Devalue the currency and hope the public doesn't catch on too quickly. But guess what? The public is catching on. Slowly, perhaps, grudgingly, but it's happening. And the institutions that understand this shift, the sovereign wealth funds, the central banks, and a handful of well-positioned investors, are acting accordingly. They're shifting into gold and silver, not for profit, but for survival. Because as I've said many times, this isn't gold going up, it's fiat going down. Let's talk about the mechanics here. What does this look like when it all plays out? It looks like confidence breaking, not all at once, but in stages. First, in the banking system, you get little shocks, like the failures of SVB and Credit Suisse, followed by increasingly creative bailouts. Because it's not really a question of saving banks anymore. It's a question of saving trust. Then confidence begins to erode in the currency itself. Inflation prints start rising again, not because demand is booming, but because cost-push pressures, energy prices, and imported commodity costs explode. The CPI begins to reflect what's already been evident to anyone buying food or filling a car for the last 2 years. The money doesn't stretch as far as it used to. And the Fed? It's stuck. It cannot raise rates high enough to contain this inflation without triggering a sovereign debt spiral. At over $34 trillion in national debt and rising by $2 to $3 trillion per year, every 1% increase in interest rates adds roughly $340 billion in annual interest payments. That's more than the entire military budget. So when Powell says he's being data dependent, what he really means is that he's politically cornered. The playbook now is stall and distract. Talk tough about inflation. Float the possibility of more hikes. But behind the curtain, they're quietly preparing for a revaluation event. They may not call it that directly. They may never announce it formally. But look at the behavior of those who matter. The insiders, the central banks, The bullion banks. They're accumulating physical metal hand over fist. Why? Because when confidence finally collapses, they'll need a monetary asset that doesn't rely on trust in a counterparty, and only gold fits that bill. And yes, silver too. Because while gold is the monetary asset of central banks, silver is the monetary asset of the people. It's more accessible, easier to barter, and it's woefully underpriced relative to gold. Historically, the gold-to-silver ratio has averaged around 15-to-1 to 30-to-1 over centuries. Today, it sits around 80 or 90-to-1. That is an enormous arbitrage opportunity hiding in plain sight. So let's return to the credit bubble, the real villain of this story. This isn't merely about consumer credit or auto loans. This is a global sovereign credit bubble, one where the total debt-to-GDP ratios across most developed nations now exceed 300%, with no hope of repayment. This bubble isn't just unsustainable, it's mathematically doomed. And when it bursts, it's going to wipe out far more than market cap. It's going to wipe out belief in the system. As Alasdair has often pointed out, credit and debt are two sides of the same coin. If debt becomes unpayable, and it will, then the credit that backs up all these financial assets evaporates. Banks won't lend, collateral values collapse, and liquidity vanishes overnight. And when liquidity vanishes in a credit-based monetary system, everything else collapses with it. What happens then? Well, let me paint you a picture. Imagine waking up to find your retirement fund down 60%, your home equity line frozen, treasury bonds yielding next to nothing, even as inflation gallops past 8%. Again, banks start limiting withdrawals for security reasons, and the talking heads on CNBC smile nervously as the Dow drops 2,000 points before lunch. Now imagine the same scene, but you're holding physical gold and silver. Your purchasing power is intact. Better yet, rising. You're not part of the problem, you're outside the system, holding the only form of money that has survived every fiat collapse in history. That's not hyperbole, that's math. And when that realization dawns, not just among gold bugs and macro nerds, but among everyday investors, institutions, and eventually even governments, you're going to see the biggest repricing of gold and silver the world has ever witnessed. Not a rally, a revaluation. You'll hear the same excuses trotted out. It's speculative, it's just fear-driven, it's temporary. They'll try everything to keep the public from rushing the exits. But history shows us that once the herd starts to move, nothing can stop it. So what does 3,000 gold mean? It means nothing if you don't understand why we're going there. It's not a target. It's not a trading signal. It's a symptom of something much bigger, a signal that the purchasing power of fiat currency is collapsing, slowly at first, then all at once. It means the financial elite are quietly preparing for a world where fiat debt is no longer the foundation of the monetary system, and physical gold is once again a core pillar of monetary trust. It means the reckoning is already underway. And let's not forget what happens when this revaluation becomes politically necessary. A single executive order could change everything. Revaluing gold from its outdated balance sheet value of $42.22 an ounce to just $4,000 would instantly inject over $1 trillion into the U.S. Treasury General account. At $10,000 an ounce, that's $2.5 trillion. And it wouldn't require a vote in Congress. It would only take a phone call from the Treasury Secretary to the Fed chair. Do you see where this goes? We are heading into an era where gold will be reintroduced not just as an investment, but as a monetary anchor. Not in name, perhaps, not in some formal Bretton Woods revival, but in function. The market will force it. Trust will demand it. And when that happens, those who own gold will not just survive, they'll lead. And silver? Silver will be the leverage play, the people's hedge. When it moves, and I mean really moves, it will be explosive. You think $50 is the ceiling? Number. It's the floor in waiting. Once silver decisively breaks that threshold, it will enter a new paradigm, and the reversion to the historic gold-silver ratio will pull it toward $100, $150, and possibly even higher. This isn't wishful thinking, it's already beginning. Now is the time to act, because once the headlines change, once gold is no longer mocked, but praised, Once silver is no longer dismissed but demanded, it will be too late. You won't be buying the opportunity. You'll be chasing it. And those of us who've seen this coming, who've read the history, done the math, and tuned out the noise, will already be positioned. So if you're listening now, understand this. You don't need to time the top. You just need to own the bottom. You don't need to bet the farm. You just need to move some of your paper out of the system and into real money. And you need to do it before the next revaluation writes a new chapter in the story of gold and rewrites the fate of fiat. Because history doesn't repeat itself, but it does rhyme. And right now, the rhythm is unmistakable.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.